Good morning, everyone. This is Jeff Cooper with the Daily Market Report coming to you on Monday morning, about an hour before the open. And today we're going to look at where the market is and why this week may be the most important. Probably is the most important since early October. Excuse me, when we projected a red October. Smart people tell me not to write about politics, to keep it about the market, because all I'll do is aggravate 50% of the people while I'll be preaching to the choir with the other half. However, social facts have become political events. The stock market itself has become an applause meter for politicians, and the Fed has become the market's errand boy. The stock market dependent, not data dependent Fed just did the FOMC moonwalk once again, coming in to mop up the market's puke. At the same time, to a large degree, the market has ceased to become the price discovery mechanism it's meant to be, due to ETFism and electronification of trading. It's not as much a discounting and anticipatory mechanism as it used to be, as it is now a reactive, systematic mechanism. The message of the market now seems to be like looking in a funhouse mirror. It has become a warped image of the price discovery mechanism it's designed to be. I think the schizophrenia is just starting. In other words, the economy is supposed to be super strong, yet the market declined 20% in a matter of 3 months, from early October to late December. The market of the last year underscores this disconnect with this 20% decline during a supposedly strong economy. Got fundamentals? The decline in October to December, of course, followed a near 15% drop in just 10 days last February. Both drops occurred right from strong runs to all-time highs. A dyed-in-the-wool bull or bear could be pretty unhappy campers at times over the past year, as each would have strong moves against their bias. However, a trader with serious schizophrenic tendencies could be in heaven. Is it now a bear market? Did the bull market just return after a rest? Who cares? Those who can't decide what the market is and whether it's going up or down don't have long to wait to be correct. The bulls and the bears seem to have a much longer wait. The main thing I've tried to do with my daily market report has never changed. I write the letter to try to share something I feel is worthwhile. As I said earlier, in September we wrote about expecting a red October. In late December, we wrote and tweeted, when this thing turns, it's going to be the Hulk. Within a few days, the market saw the biggest one-day point gain in history on December 26th. From the December 24th closing low, right here, the S&P is up 246 points in 11 trading days, during which there was only one day down of consequence, January 3rd. That's right here. So, indeed, this was the Hulk off the lows. Last week, we commented that it seemed that everyone was looking for a backtest of the neckline of the S&P 2018 Head and Shoulders top formation. Let's go to a weekly and you can see what I'm talking about. Here's this neckline here. Left shoulder, head, droop right shoulder, and it seems like the vast majority of technicians were looking for a picture-perfect backtest of this neckline before reaction. Now we want to go back to the hourlies. So this neckline ties to 2620-ish. Consequently, because most people seem to be looking for this, most traders seem to be looking for higher prices before any reaction, we stated that the index would probably fall shy of 2620 or go meaningfully north of 2620 before a reaction. This is probably typical This is because typically what everyone knows on Wall Street is seldom worth knowing, at least at that moment. It looks like we may have our answer this morning with the Futs down as much as 29 points overnight. On Friday, we flagged the S&P's NR 7-day. Let's take a look at the dailies. You can see this is an NR 7-day is the narrowest range in 7 days. And certainly this is the narrowest range. Friday was the narrowest range since the lows. Typically, these contractions see an expansion in volatility within the next few sessions. After an 11-day line drive move with little volatility, an expansion of volatility here could pack a real punch. We've been looking for a pullback toward 2520. That's right here. It represents the high of the first leg up off the lows. I would not be surprised to see 2500, the 2500 S&P strike tagged prior to the first monthly option expiration this week on Friday. So this is an hourly, back to the hourly, this is an hourly S&P from the October turn. If I pull it back a little further, you'll see the October high, okay? It shows the S&P has rallied shy of this idealized resistance at 2620 right here. It's also shy of a picture-perfect 50% retrace of the down leg, which ties to 2643, 2644. At the same time, 2619, just above and basically ties to the neckline, is where wave C, this is an A wave up off the, my interpretation is this is an A wave up off the low, a B wave correction, and this is a C wave. And C would have equaled A at 2619. So there was massive resistance at 2620, and a lot of players were looking for that level to be tagged first prior to any pullback. Again, my thinking was the S&P rally would probably be shy of that level, at least on this go round. And this next pullback is going to be critical for several reasons. First, the ABC structure we just looked at on the S&P looks like a fractal of the ABC rally from late October to December 3rd. And that's going to best be seen looking at the dailies. So I'm saying that this ABC is a fractal of this A, B, C, which may have carved out a wave 2 corrective rally. So in other words, this looks like a leg 1 or wave 1 down, an ABC for a 2 wave. This waterfall drop, runaway downside move is clearly consistent with a third wave, a powerful third wave down, and this ABC may have defined and may have completed a fourth wave up. If this interpretation is correct, the implication is new lows ahead, somewhat below the December low to satisfy 5 waves down. Typically, markets play out in 5 ways. However, there is another scenario which suggests potential for a waterfall decline to significantly lower lows. In my report throughout the last half of 2018, we detailed the synergy between the patterns from 1929 and 1987. We're not going to get into that here, but the percentage drop off the first break in 1929 is equivalent to an S&P low of 2446 off last September's high. However, off the December top, it's equivalent to 2324 S&P. The December low for the move, of course, was 2346. Following the first low off the 1929 top, there was a sharp rebound of around 7 trading days. So it's going to be interesting to see if, let's take a look at the weeklies. There's two scenarios. It's going to be interesting to see if this represents first sharp rebound off a larger decline a la 1929, and this is a midpoint of a decline that's going to take us down to 2260, which represents the projection off this head and shoulders top formation, with this being the neckline, or to as low as 2100, which ties to the May 2015 top, right back here, or even down in a crash to 1810, which ties to the early 2016 low over here. However, one pattern which I've seen nobody thinking about is the possibility that this whole picture here, this whole pattern, may be a large A, B, C in of itself. Interestingly, this low ties to a 50% retrace of this entire rally from the 1810-2016 low to the 2941 September 2018 top. The midpoint is 2375, 2376, and this was tested, slightly undercut, with the December 24th Christmas Eve low of 2346. So how are we going to know if that's the case? If we recapture 50% of this entire decline at around 2644 and hold and continue to extend, the chances are we're going to make a trip back to the highs and possibly may even exceed them. So what to watch for? The levels to watch on the downside are going to be 2500 to 2520, as we mentioned before. Below that requires extreme defense, especially if 2470 is breached. Why and how do I come up with these numbers? Well, 2520 was the high of the first leg up. Let me go back to the hourlies quickly. 2520 was the high of the first leg up, off the low, and prior resistance should become support. 50% retrace of this entire rally is now 2472. This also ties to an open gap right here from January 24th, around 2460 to 2470. Got geometry? So my interpretation, if the market gaps down today and stays down after the first hour today, it may catch the majority of players leaning the wrong way, waiting for the 20 who have been waiting for this 2620 neckline and or a picture perfect backtest of the 50-day moving average 2635 to be struck before locking in gains. So arguably, we are either at a midpoint of a decline with a possible 1929 style waterfall ahead to 2100 to 2260 to as low as 1810, or the S&P is poised for a rip to test and exceed all-time highs. I want to go back to the weeklies before we finish up this morning. The case for new highs revolves around the notion that the drop in February was this A wave decline followed by the B wave to nominal new highs, and that's consistent with the character of B waves and false breakouts. In this interpretation, the October-December drop was the sharp C wave. This week is the ideal time for a downturn to commence, if it's going to. Why? Let's zoom in here. The S&P is in my weekly -1 +2 sell position. This is because the 3-week chart is pointing down. You had 3 consecutive lower weekly lows, which satisfies the -1 part of my method. And now 2 consecutive higher weekly highs. Nothing to do with closes. All you need for a higher weekly high is a move or trade above the prior week's high. And this was the first higher weekly high. This last week was the second higher weekly high. And when the 3-week chart is pointing down, and then you get whenever you get 2 weekly higher highs, as long as the 3-week chart remains pointing down, this satisfies my or puts the item in the -1, the weekly -1 +2 sell pattern. I say weekly because the same pattern, the same setup can exist on the dailies. Obviously, it's a much bigger deal when it occurs on the weeklies. So if we get downside follow through here, even if it turns out to be a higher low than this low, say down into this region here, 2460, 2470, or even 2500, 2520, it underscores the value of this -1 +2 method, which revolves around time versus price. In other words, while there were idealized prices that could have been struck before reaction, 2620, 2640, the S&P had satisfied a time factor in as much as it had carved out 2 consecutive higher daily highs. This is a good example of how, as W.D. Gann said, time turns trend. He did not say price turns trend. The idea of a big 1-year ABC decline, ABC pattern, relates to the concept of a possible mirror image foldback. In other words, the index could now be at a juncture where it was in early February back here and knife back up to 2940 plus. The drop in early February was 350 points. If this is a mirror image foldback, we could march up this same 340 points from this 2600 level in a mirror image foldback to this 340 point decline. What would tip us off to such an eventuality? If the S&P reclaims its 50-day moving average, as I said before, and 50% of this decline, this whole decline, and holds, it could indicate such a move is on the table. In my experience, recapturing the midpoint of a decline after a flush out, which in this case is 2644, and holding, puts this in the wheelhouse for a push to new highs. The S&P reversed in December after satisfying a 50% retrace of the 2016-2018 range, as we noted before. So likewise, I would not underestimate a move that recaptures 50% of this decline and holds. Importantly, notice that if the S&P installs a new high over the next weeks or months, that it will satisfy a megaphone or broadening top formation. This is a pattern of higher highs and higher lows. So here's your megaphone. It's a 5-way or 5-point pattern. 1, 2, actually this is 1, 2, 3, 4, and the new high would be 5. So you have a succession of higher highs, if that should play out, and lower lows. So you can see the idea of this megaphone. I haven't drawn it in, but this would be the upper rail of the megaphone, and this would be the lower rail of the megaphone. So the September high was higher than the January high, and the December low was lower than the February low, and a new high above the September high would fulfill the pattern of a possible megaphone top. This and the cycles is why I say a multi-year bear market would follow any new high. So is it 1929 or is it new highs? It may be both, with a newfound schizo volatility trumping the tape. So buckle up. What we've seen over the last year may be just an appetizer as to what's in store in 2019. Drilling down to the short term real quick, I find it interesting that Friday was an NR7 day on the heels of Thursday's outside up day. Let's take a look real quick at the dailies. So Thursday was an outside up day, and the normal expectation is to see follow through after an outside up day. And Friday was an hour range day, an NR7 day. The expectation may be that Friday was a pause day after Thursday's outside up impulse. However, if the S&P now knifes below Thursday's low of 2562, which it is poised to do on any follow through this morning, it will trigger a reversal of reversal, or what I call a Kaiser Soze. If this 2562 level is breached, it implies a backtest of support to 2500 and 2520, and that 2500 strike may be struck as early as Friday's first option expiration, monthly option expiration this week. That's it for now. Good luck trading today. We'll be back.